Hey, good morning everyone. It is me, Rags to Riches, back with another video for you today. I wanted to sit and have a brief chat with you in the morning before I got ready to head off into the city and dish out these lending facilities that I do for my clients, and to talk to you about something which is pretty important and a little piece of advice that might be interesting for you to consider. And that is going to be emergency fund savings. Everyone needs an emergency fund. I don't care if you have $1 billion, if you have $0, if you have a negative net worth. What if something happens that you don't want to actually sell your stocks, sell your stuff? What if life happens? Examples being, what if you lost your job? What if your spouse became sick? What if your car broke down? What if you need to go on a vacation? Or what if you need to take a trip away that otherwise you don't have the cash on hand for? This is why you plan ahead and you save money. Now, traditionally, when I grew up, the way that you're told to save your money is to go to the bank to open up a savings account. In the past few years, they have quote unquote high yield savings accounts, which are paying you 1 to 2% interest. You put your money in there, and then when time comes around where you need to pull out the money, when life happens, you do so. And that's a fine strategy. The goal of a savings account is that it's liquid. You can draw upon it when you need to. It's there and available for use. The issue is, working for a bank, I can attest to this. We're bankers, and we're a little bit greedy, and we're not going to pay you more than we think we need to get the money. That's just kind of the reality of the matter, guys. Like, you can't expect a bunch of people in finance who work with money, work with people with money, move money, trade money, invest money, lend money to not want to make money. On that note, though, I just wheel little me here, Vermonter man. I do care about, the broader good about the world, and I wanted to share with you a technique that I've been employing for my emergency fund savings instead of actually putting it into a savings account. This is going to get into what I'm personally doing as an individual. I want to preface this by saying this is not a recommendation for financial advice. Any invested capital, should you choose to follow a similar strategy that I am about to present, could result in you losing all of your initial investment, and that is a consequence that you need to be prepared to deal with. Albeit, given the nature of what I am going to be showing you for my personal balance sheet, this is something that I personally believe is a fairly risk-free bet, but of course I think it's important to understand the risk and disclosures when you're talking about things like securities, right? Getting into that, let me actually open up my Brave browser here. Just bear with me. We'll get into this little Excel in a moment. So, I am on the Fidelity website right now, and I want to talk to you guys today about boomer fixed income. Yeah, man, I know. It's not always about buying shares and penny stocks. Now, let me talk to you about fixed income and kind of the goal behind using this instead of a savings account. There are three main types of fixed income securities that are going to be sponsored by the federal government. These are going to be Treasury bills, Treasury notes, and Treasury bonds. Now, when everyone says the bond market, it's really just like a acronym or a misnomer for what type of security that you're actually purchasing. Let's get into the difference between the three. A Treasury bill is a fixed income security issued by the federal government, sold to the investment public, that has maturity within 12 months. A Treasury note is a fixed income security that has a maturity between 12 months and, depending on what type of metric you're talking about, maybe up to 2 to 5 years. A Treasury bond, on the other hand, is a fixed income security that has maturity between 2 to 5 years to, generally they cap it at 30 years, but sometimes there's longer issuances. And what do I mean by a fixed income security? Well, fixed income is really simple, guys. Instead of you going to the bank, asking them for a loan, you get the money and then you periodically pay them back interest and principal on a monthly basis. The government, as governments often do, spends more money than they actually have on hand, and to fund their spending, or when there's a period in time where there's a lapse in tax revenue to make up for that spending in the short term, they'll issue bonds. And really what a bond is you loaning the government your money. In return, they're going to pay you back interest on a monthly basis, and then at the time of maturity, you will get back your principal investment. So, why do I bring up fixed income instead of a savings account? Well, the cool thing about fixed income is that when your issuer is going to be the U.S. Treasury or the U.S. government, provided that you believe in the full faith and credit of the American government, if Uncle Sam is not going to go down under fire in the next 1, 2, 3, 4, 5, 6 months, the intended amount of time, by the way, you want to have an emergency fund saved for, then perhaps this is an investment that you might want to take. And why might you want to take that additional risk instead of having your money sitting at the bank? You can get a higher yield. Today, the national average for a high yield savings account could range you between 5 basis points, that's 0.05%. Maybe it's some regional banks up to 2 to 3%. Online brokerage firms, they have these promotions saying you can get savings of up to 5.5%, but those are money market securities. Now, I can break down why those are relatively reasonable in a moment, as they are a part of the strategy, but the goal of me telling you about this is to really show you how to look up fixed income investments, right? So, when I created my fixed income portfolio or my high yield savings account, I'd rather be the bank. I went to this page. How do I find a bond? I click on 1, news and research, fixed income and bonds. They have CDs, they have other types of fixed income, say from corporate issuers, municipals, agency mortgage-backed securities, things along those lines. Today we're just talking about U.S. Treasury-backed securities. So we're going to click on bonds. Number 2, you need to know when you need your T-bills to mature, because Treasury bills are not cash. You can't go to the grocery store and say, let me buy $1,000 worth of Treasury bills and you can give me my groceries. They're not cash. So how do you structure what's known as the Treasury bill ladder? Number 1, you need to determine your monthly spend. Let's say, as an example, it's $2,000 a month. You know you have a non-discretionary spending needs. I have my rent, I have my utilities, I have my food, etc. You'll have that sitting in cash, maybe in a money market fund. Then you want to have in cash between 3 and 6 months of cash that you can invest outside of that first month in liquidity. So if today is February 5th, the first Treasury bill I'd want to buy would have maturity in May of 2024. Then I would check May in 2024 for the second tranche. So this is going to let me know that I can buy a Treasury bill that will mature or give me back my principal investment in May of 2024. Select bills here because these are the lowest risk because they have the shortest maturity. Once you click on that button, you're going to see the different treasuries that are available. These are often going to be quoted in terms of highest yield down to lowest yield. The industry norm and regulatory requirement is that these are quoted on a basis of the highest. You should quote the yield to worst, or the lower of the yield to worst to the yield to maturity between the two. And Fidelity is a very nice broker, and they'll let you know which one actually has the highest yield to worst at a given time. So, example here being, I can see that if I want a Treasury bill that's going to mature on or about the beginning of May, so about 30 days from today, I can get a annualized yield. So you're not going to get the full yield in that given period, but you'll get 30 days worth of this yield to worst of 5.34%. This is far above and beyond what you can get in a traditional savings account. So I would click on this, buy. You would select your price. You do have to buy at least $1,000 worth, as those are the denominations for Treasury bills. And because I don't want to disclose my account information, I'm not actually going to select an account here, but that's how you would do it. So going back to the strategy, let's say I just bought the May maturity Treasury bill. Great. Now I still have a few additional months that I want to actually lock in that yield to guarantee that rate of return to get that higher interest rate compared to that of a savings account. So If we already covered May, that's my May expected expending if I needed it. I would click on June 2024 and June of 2024, and then click on Treasury bills. Again, click on the QSIPs. Again, I can see they're going to be quoted from maturity date and in terms of yield to worst. I'd buy another one. So the goal here of this video is to show you that there is a way, relatively risk-free, of course nothing is completely risk-free, but in a relative basis, to actually pick up additional yield instead of that of a high-yield savings account. That's what I'm doing for my personal savings. I have a 6-month T-bill ladder, meaning I have 30 days of cash for the month of April. I have a T-bill maturing in May. I have a T-bill maturing in June, July, August, September, October, etc. Every month, when one of those T-bills mature, I just buy a new one for the latest maturity that I'm not covered for. This gives me 30 days worth of cash, which I know I will need to spend in the worst case scenario. Then, if I burn through that in the worst case scenario, oh, good news. The T-bill for May is already matured, so now I have 30 days worth more cash. All the while, I'm picking up much higher incremental yield than you would get in a traditional bank or a savings account. And the fun part is, because it's expected the Fed is going to begin to cut rates, perhaps in June, perhaps in July, perhaps in August, but is in the cards and is coming up soon, you can actually lock in that yield for much longer than you could with a savings account. Because what are the banks going to do the moment the Fed cuts rates? They're going to cut the interest on your savings account because they don't want to pay you more. So, just a fun fact. I do want to just briefly touch on this Excel here. This is how I'm tracking my personal balance sheet or my quote-unquote hedge fund. I do mine and operate some Bitcoin, and these are the different positions or general accounts that I have. Have some cash, had some savings. This is the high yield savings account, the about 6 months worth of expenses that I had mentioned before. I do have my growth stock portfolio, my 401k, my Roth IRA, do got some Bitcoin. I got to stack that up a little bit further, my altcoins, private equity, and then real estate hard money loans via ground floor. I suppose I should do a deeper dive video on each one of these should you be interested. So please like, subscribe, and let me know in the comments if you'd be interested in having a deep dive done on that. Cool thing about this portfolio is that it's income oriented, and because of that, plus the operating income from my cryptocurrency miners that you can see here, I'm stacking an additional $7,800 per year just for my investments. Now, I'm not just early retiree trying to only focus on passive income. I also care about a rate of return, and because of that, I have also been tracking returns. And the cool thing is about my investment strategy, we are beating the NASDAQ by about 20.21% since tracking and 17.9% compared to the S&P 500 since February 2nd of 2024. 2-month run rate is not indicative of longer term returns, but I do like to think that, for 2 months, 20% alpha is not bad at all. I'm up 21.68%. Cool. Now, a lot of that has been driven by the macro secular trends of cryptocurrency, my Bitcoin position, as well as some of the altcoins that I own. My equity positions have been doing very well in addition to that, and I'd love to do a further breakdown at a future date to give you guys a glance of what that looks like. But yeah, here are the charts. If you would have invested $10,000 in my portfolio at the time of starting the track, in the S&P 500, you'd be at $10,378. The NASDAQ, you'd be up about $147. And then with my investment, you'd be up about $2,168 from your $10,000 initial investment. I like gray lines that make blue and orange lines look tiny, and that's what we've done here today. So, on that note, wishing you guys the best as you head into the weekend. We are heading into springtime, so if you have any kind of backyard or garden, I will be spending some time out there this weekend to get it prepped and ready for the spring. Get some grass seed down, maybe do a little bit of weeding to make sure that nothing nasty starts popping up in the grass. But, long term, I just want to conclude by saying, really appreciate any of you guys who are liking this content. I think really good financial education out there is hard to find. I am by no means a definitive expert. There are people with much more time and experience than me on the street. What I do know is that I really am passionate about the subject, and for anyone that has found this interesting or helpful, be sure to like, subscribe, and share with your friends. And by the way, don't pay us at the bank because we're just going to take your money. How about you just invest it yourself? Because what I just showed you is literally what we would do with your savings account. Bye now.